guys, welcome back to my channel. I'm your host Miss KK and this is The Wave, your weekly show on all things money. On this show, we get to dissect topics related to personal, family and business finances, and my hope is that by the time we get to the end of the series, you'll be better equipped to make sound financial decisions. If you are new here, thank you very much for stopping by. Please consider clicking the subscription button in the comment below so that you can be notified every time we get a new video. And if you are already a subscriber, thank you so much for your continued support and interaction in the comment below. It is highly appreciated. All right, let's see what we get in store for today. But before we get to that, I hope you really enjoyed the Olympics this weekend. It was jam-packed with actions and I really enjoyed it. I hope you're also watching. If you joined us last week, we've started a new topic, which is a series about business. And previously, before that, we've only been talking about personal finances, and we've decided to touch a bit of business finance before we move on to family finance. And because the concept is so broad, we might be switching between other topics and then continue the series later. So in last week's video, we started understanding the top 2 reasons why your business could be failing. And we said number 1 was lack of industry analysis, meaning that you get into an industry that you're not really familiar with and you also use incorrect pricing. You are charging the wrong prices to the customer. Ultimately, your business is bleeding money and you end up losing in the end. So today we are continuing on other reasons why your businesses might be failing that are of particular importance that I believe you need to pay attention to if you are trying to make your business a success. The first thing I really want to talk about is lack of accounting records. For a lot of us are not familiar with keeping accounting books, and when I mean accounting records, I don't really mean a full set of books like it's required in terms of the international standards of accounting, but really what I'm basically trying to illustrate here is at any point in time, if someone were to ask you, how much is your business making in terms of profit in each month and how much is your business worth at this particular point in time? You should be able to answer those questions because ultimately what you are expected to do is you are expected to keep some sort of record to determine how much sales you are making in a given month, i.e. how much is money flowing in the business and how much money are you really spending out in terms of employees and operational costs, and the net of those two, you either making a profit or you are losing. If you are losing, you need to be able to address where your money is leaking and hopefully turn the situation around, because ultimately if you are losing money, you are actually running your business to the ground. On the other hand, you also need to be able to keep a list of all your business's assets and all your business liabilities so that you can see if you have to sell this business at any point in time, you can tell someone, this is what my net book value is, my assets minus my liability, and if I add my goodwill and all this business reputation I've built up, I'm prepared to receive X amount of money for what my business is worth. So really, if you don't have that information, you are unlikely to succeed. So what I'm trying to recommend here is get a simple book and write out your daily sales, write out your daily expenses, and at the end of the month, really tally up all of that so that you can determine whether you made a profit in that particular month or you made a loss in that particular month. When we started doing business, for me personally, I'm an accountant, so that makes it easier for me to keep this record. But on the other hand, my husband isn't really an accountant, so he's not into this recording business. So when we started with the first car in the driving school, we were not really strict about the finances. But as we expanded as we acquired more assets and more cars with the business, I started being strict with the finances. I record every time so that I can be able to assess, is it worthwhile for us to continue this business? So if I didn't do this recording, for example, when my friend Primus and I were in the chicken business, if we didn't have accounting record, we wouldn't have known that the input costs have risen so much within a short period of time, such that we started losing money. So for example, at that point in time, the input cost was rising because of the drought that affected the farming community, meaning maize and all other input costs that are used in chicken feed was getting so expensive, but the prices were so sensitive to demand. So we couldn't increase the selling price to the customer at the same rate that the input cost was increasing. And as a result, we started making a loss. So we had to make the judgment call to pull out of that industry because we didn't think we could recover so quickly to make up for those losses. So it was only because of the accounting record that we were able to do this. So reflect to yourself, do I have any records? How do I check whether I'm making a loss or not? And should I start perhaps implementing some of this? So that is another reason why I think your business could be failing. Another one is lack of growth. Yes, for a lot of us start businesses and we just remain as such. You've been in the driving school business for so many years and you only have one driving school car. Not necessarily because you don't have the money to buy another car, not necessarily because you're not making money in the only car that you have, but just because you don't have that intention to scale up. So really the theme for this year personally for us is scaling for growth, because you can only really make money when you expand, because when you expand, that ultimately means your income earning capability has increases. That ultimately means that you can now earn more money. So take for example someone that has one taxi that nets, for example, on a monthly base 8,000. If they have one car, that means they can only make 8,000. But if they have two cars, that all of a sudden increases to 16,000. So what I'm ultimately trying to drive here is you need to assess if the business is profitable enough. Is it perhaps time for you to reinvest that money that you are making in a particular month, and also bring in some personal savings so that you can invest more in another car so that you can increase your income earning capability instead of pulling out that profit every single month? Because if you keep pulling out that profit every single month, your business will just remain as that, small as that. 20 years, you still have one taxi. So basically that's what I'm trying to get to. And lastly, which I want us to discuss today, is incorrect financing. So what you normally do is you either finance the business with your personal funds, or you go out and borrow money. If you go out and borrow money, you can either get a short-term financing, or you can get a medium to long-term financing. Your short-term finances are things like personal loans that are repayable over 12 to 36 months, or you have things like an overdraft you can repay back on demand. But you also have long-term financing where you take maybe a loan for over a 5 to 10 year period, or maybe if it's property finances, it can also span over a 25 to 30 years. So what you end up with small businesses, the person takes a 5-year term loan to finance stock, and stock will be sold within a period of 12 months. Now you sell the stock within the period of 12 months, you recover the money and you use up the money for something else, but this loan is already, it's still sitting in your book. So there's a mismatch. You've used long-term financing to finance short-term financing needs. And the opposite could also happen. You can find someone is taking an asset and they're trying to finance that asset with an overdraft. What we need to understand is short-term financing also tend to be a lot expensive than long-term financing, especially if it's not linked to a tangible asset that can be used as security. So what you'd want to do is you want to make sure that if you are going to take short-term finances, you are using it for something that is short-term in nature. For example, if it's an overdraft, it must be used to acquire stock. If it's a long-term loan, it must be used to purchase maybe a building or a vehicle that you can drive for 5 years, or a building that you can use up to 50 years. So ultimately, if you end up using incorrect stocks for incorrect financing for incorrect needs, you end up either having to use up the money for a loan that you're still going to continue to carry on your balance sheet, or you are going to be charged an incorrect interest rate because you unfortunately used the wrong financing. So really, that's all I wanted us to drive from today's video. I hope you enjoyed it, and I hope you continue following us so that you can learn more about this topic. That's all we had from today's discussion. I really thank you for being with us. If you haven't, please consider clicking the subscription button in the comment below so that you can be notified every time we upload a new video. And that's all we had from today. It is goodbye.